Susanna.
All right. Hi, Kay. Thanks for joining us. It's amazing having you here.
All right, 6:30, you guys ready to get started?
Totally.
Okay. Thanks so much for coming, everybody. I actually work with Susanna behind the scenes. I'm her marketing director. We're so glad you're here. We really hope you find this informative. I'm going to turn it over to Susanna and Kim. I know you guys know Susanna, but you might not know Kim, just so they can give you a little bit about who they are and what they do, and then we'll get started.
All right, awesome. So I will just start with sharing the screen here. Okay. I hope you can all see that. If you have any questions, so there is a chat, so you should see in the bottom of your screen, you should see a little dashboard, and it says chat. So if you click on that, you'll see a chat on the side pop up, and if you have any questions, you know, please, you know, put your questions in there and we'll answer them. And later on, I mean, we can do a little Q&A if we have enough time. So, okay. Well, let's get started here. I'm Susanna Haynie. I have been in real estate for 12 years. I have my license for 12 years. I've been in real estate longer. I was in marketing real estate before. I am the owner broker of Colorado Real Estate Group. And yeah, real estate, I think, is my passion. I work with buyers, sellers, and investors. Actually, you know, I started the same time as kim.majors.
Hello. As Susanna said, my name is Kim.majors. I am with Bank Central Mortgage, which is a local lender here in Colorado Springs. I originate the loans, so I'm the one at the front end of mortgages, putting together pre-approvals or options or numbers. I'm the money person. And yeah, Susanna and I we've met probably about 12 years ago.
Yep. Long time. Time passes by.
Yep.
All right.
Awesome. So I'll get started just as far as if there's anything you guys take away from tonight, the two key things to remember if you're thinking about trading up your home in the near future is time and talk. So you want to give yourself as much time as possible, even if you're considering, you know, selling your current house 2 years from now. It's great to get that conversation started with the experts in that field. So your realtor, Susanna, your lender, Kim, so that they can give you an idea of exactly what steps you need to put in place to set you up for success. So those conversations as early as possible is really key. And then I'm going to hand it over to Susanna, kind of talk about what's happening in the real estate side of things right now and how that plays out for trading up.
Yes, so starting early has two benefits. One is you really, oh, hold on, there's Marlon. You know, you give yourself enough time to figure out what it is you need to do. On the real estate side, it's certainly, you know, preparing your house that, you know, if you have to sell your house in order to, you know, trade up to another house, or you have to prepare your home for a next renter, and you can, you know, we can talk about all the research that, you know, needs to be done. How much rent can you get? You know, what is your house worth right now? And well, what does the future look like for you in the market? And so that's what's important to me. So I can get you started then and there, and you can start making decisions that set you on the path to being prepared. So when the time comes, you don't have to jump through hoops. Kim, over to you.
Yep. From a lending standpoint, there honestly is a point that it's never too early to get started. And the reason being on that is, if you start the process really early, even a year out, 2 years out, whatever, you start it really, really early. If you're ready to go at that time, then perfect. You're ready to go at that time. Then we just revisit everything, and, we just renew everything that we talked about 2 years down the line when you're ready, which usually just involves, has anything changed in your life, pull a new credit report, stuff like that, so that you're ready to go. On the other side, if you're not ready to go, it gives me as much time as possible to get you in line, the steps that we need to do, whether it has to do with debt to income ratios or credit, you know what I mean? All the nitty gritties of what comes into qualifying for a mortgage. It helps me look into it, get you as prepared as possible, and provide you as many options as possible well far in advance, which we're going to talk to kind of further along the lines in terms of where you get money for down payment on the next house and stuff like that. So starting really soon gives us enough time to plan a path if that's what's needed.
Yes, and once you are prepared, that also plays into what you're seeing right now, the current market trends. We are at this time, everybody has heard that, oh my gosh, the market is so bad. But when you are prepared, you can take advantage of the little fluctuations that we currently see in the market. So, for example, the interest rates dipped last week. I don't know where they are now. Kim will tell you all about that, just so that you have a reference. But the interest rates dipped just, in the last 10 days. And what happened, all of a sudden, I had buyers just coming out and saying, hey, we want to buy now. So I was writing offers like crazy last week. And believe it or not, I was encountering multiple offers, which gave me total flashbacks to last year. So when you are prepared, that means when we have those dips and we see that dynamic, you can be very, proactive, reactive, and say, oh my gosh, something is happening in the market. We can put the house on and list it because we want to take advantage of this competition.
Yep.
So where are the rates now, Kim?
We are, obviously depends on loan type and credit scores and all that, but you're basics, you're looking really pretty much in the low 6s realm, just to kind of give a really basic average. But of course, that'll fluctuate depending on down payment, credit score, all of that stuff. And that actually, little tidbit to throw in here, they're actually changing the loan level pricing adjustments. I don't know if that's been any buzz. We go through loan level pricing adjustments when somebody, in terms of their interest rate. So credit score is a big one. Loan to value is a big one. But they just announced that they're adding in debt to income ratio as one of them. So that's going to be another place where you could see an impact on interest rates. So that's an interesting change in our market. Nothing to worry you. On average, we've seen, obviously last year was a year that rates climbed the whole year. And we finally did stabilize a little bit towards the end of the year. And I would say we've probably come down about 1% from the highest that we've seen. And we've been a little steady, as Susanna says. We'll see a little dip, and then it'll kind of come up a little bit, and then we see a little dip. But we've been pretty steady in the last couple of months in comparison to all of last year. So fingers crossed. I really hope we continue in that direction or get better. But of course, we do not have a perfect crystal ball.
And just to kind of address the common misconceptions, it's too hard to sell right now. Again, I have experienced multiple offer situations in the last couple weeks. And honestly, we still don't have enough homes for sale. So in the number of active listings of 1909, There are townhomes and condos included. So everybody, and I checked earlier, the active listings for single family homes were 1,300-ish, you know. It's not enough. We have how many 700,000 residents in Colorado Springs? 1,300 still isn't that much. So preparing your house and pricing it well, you know, that's the key. So it's not as crazy as 2021, but quite frankly, that was just not sustainable.
Agreed.
So, you know, things have calmed down, and it's going to be just, you know, it's going to be a little bumpy this year, no doubt. So. Okay. This is me, I think. Okay. How long will your house be on the market? You saw the average on market time is 41 days. I expect that to shorten, if at all, only a little bit, depending on the interest rates. Like I said, if interest rates magically should really lower quite a bit, we will have a run on houses. We don't know if that's going to happen. We have a few, you know, variables that we're just not sure how they're going to develop, you know, like with the debt ceiling and so on. So that will all play into this. Why are some homes selling faster than others? Preparation and pricing. So if the house is staged well and it's priced well to really, you know, make buyers raise their paddle, that will have a huge impact.
That's where you're seeing those multiple offer situations still happening at sort of surprise price ranges as well, even though we've had a break from that, right, Susanna?
So yes, we had a break from that. I will tell you that under 400, it's been more competitive regardless, because people are still trying to get into houses, and that's just where a lot of buyers are. The multiple offers I have seen in the 500s and 600s mainly in the past few weeks. So there is still an opportunity to purchase. We have plenty of houses that have been on the market for 170 days, for example, that I just looked at today, 140, 115. And these sellers are willing to negotiate. So it's just a matter of actually being brave and just say, you know, we don't have to look at, you know, if you're looking to buy a house at 600, you have to, you know, last year you had to look at a house that was listed at 550 because you had to bid 50 over. So those days are over. You can actually look at 625 and, you know, and then just kind of get close to it. And especially if a house has been on the market for longer, that should be fine.
And would you say it's kind of an awkward time period, kind of how we've discussed, where a lot of sellers are still wanting it to be like 2021, and so they're overpriced and wanting to put their house on the market without a lot of preparation? Would you say that's a factor still happening right now?
Yes, there are a couple things that are really hard, you know, as a real estate professional, and that I just explain over and over again. One of them is such a thing that, yeah, you know, we can, when we say we need to be aggressive in price, that means actually aggressive, not pushing too hard. The house needs to be really well prepared, you know, and I'm not talking about, you know, huge updates or upgrades, but, you know, clean, good paint, well staged. You know, I mean, even if it means taking some of your furniture out and replacing it with some modern furniture. I know that's a lot of work, but it'll pay off.
Dude, she just what she just said. That it needs to be
Oh, okay. So it is a lot of work. It definitely is a lot of work, but just remember that if you buy and sell at this, or sell and buy at the same time, there are several transactions that are coming together. You have the preparation and sale of your house, and you deal with the buyer on the other side. You deal with the purchase on your end and the seller on that side, and you're dealing with the lending part, which, you know, I mean, those are basically 5 sides that you're dealing with. So that can be tough. Okay, so, oh, sorry. All right, Kim.
For me?
Yes.
All right. So making the money work. Perfect segue into this. And the first thing to consider when you're looking at you having a current home and buying the next one is, do you want to, or can you go into this the next purchase with or without a contingency? And what that means is putting in the offer contingent upon the sale of your home or not contingent upon the sale of your home. And that's where I always say, you know, please defer to Susanna for what's the competition level in the market, you know, or on that specific house. Do you have a fighting chance to go in with a contingency, or do you really need to try to qualify without a contingency? And there are a couple aspects of that when looking at no contingency. And that is, can you qualify carrying both homes? Because that's what we require as a lender, is that you're going to have to qualify with both mortgage payments, or if you outright own a home, we still have to include expenses on the property like taxes, insurance, homeowners insurance. But also, what does it take to buy the next home if you can qualify without selling the previous home in terms of down payment funds? And so that's why when I say you can never start too soon, this is a perfect scenario to get information from a lender on this, because you might have to game plan what you're going to do. So let's say you make the decision, we want to qualify without a contingency. I want to try to qualify with the current house, and we're going to figure out where we can get the down payment funds from to buy the next house. I also don't want to move with or deal with moving twice and so on and so forth. So you're making that decision. So the first thing we do is we look at avenues of where you can get money. And one of the first ones on here, we talk about a HELOC, and that is a home equity line of credit that you attach to your current house to be able to pull money from that house for down payment on the next house. Now, a HELOC is one thing that I recommend that a lot of banks don't love the idea of you just putting a HELOC on a house for that reason, right? You don't necessarily, you know, if you have your home listed and so on and so forth, it can be a little hard to find a bank that will put a HELOC on a house like that. So I always suggest to people, if this is a thought just in your mind for something maybe years down the road or whenever, you might want to consider attaching a HELOC to your house for that possible ability. Not necessarily, you know, you might attach it 2 years before because you want the option of paying off debt with that, or having the security blanket, anything of that sort. Having a HELOC attached to your house is a possible scenario of where you can get money from.
Can I just ask real quick?
Yeah.
That doesn't cost you anything to just have it available, correct?
Well, I can't definitively answer that because of all banks are going to be different on where you get your HELOC from, right? So most banks, if you're doing a HELOC, is going to be a very small fee to set up the HELOC. So I know, like through COVID, I feel that a lot of phone calls of people wanting to attach a HELOC to their house just for safety reasons. People weren't sure about employment. They weren't sure about anything. They had equity in their house. They wanted to attach that HELOC. So it's usually, depending on the bank, usually very inexpensive to get a HELOC. A lot of the times you don't even need an appraisal. Every situation is different, but most of the time you're only paying for that HELOC if you've drawn the funds, right? I don't know, some might have an annual fee or something like that. That I can't answer for sure. But most of the time you are only paying if you have pulled a balance on that HELOC. So a HELOC works like a credit card. So you pull the money, you use it for whatever, home improvement, debt consolidation, whatever. You eventually pay it back. That HELOC stays open on that house until you close it or until you reach the period that it's matured. And it sits there like a credit card balance, and you can pull from it again. When you do pull and you have a balance sitting on that line, you do have a monthly payment that's due. Does that help answer the question, Susanna?
Absolutely, absolutely.
Yeah, so there's no rhyme or reason to looking into getting a HELOC just sitting on your house for that safety net type of reason. Now, if you are looking to get a HELOC, you know what I mean, and your pure intentions are for down payment on the next house, you know, I always suggest you need to be honest with that. You need to be upfront with that. Let the bank know what you're doing. They will make the decision or not on what they do with the property. And that leads into, I'm actually going to skip down a couple of notches leading into that segue. I'll go back up in a minute, but there's a bridge loan, and a bridge loan is where you knowingly have your house listed or you're going to list your house, and it's a short-term loan. So usually what the bank does is it actually securitizes both properties, the property you're going to buy and the property you're going to sell. So it combines it all together in one, pays off the current mortgage of the other one. So you have one line, and you're pulling it, and they give you the funds and the bridge so that you can purchase the next house. The difference between a HELOC and a bridge are usually, and again, this can be bank dependent, a bridge loan can be more expensive in terms of fees and stuff like that. And there are things that you need to think about, like a bridge loan. And again, every bank is going to be different, but you can find banks that have a 6-month or a 12-month or an 18-month bridge. It just depends on your scenario and the length of time. And there's no perfect answer for everybody. Everybody has a different situation. And so that's why when you start talking to a lender, we can kind of help guide your path the best. So anybody that's on have a question between the HELOC and a bridge?
Feel free to put it in the chat window. We see that when you pop it in.
The biggest thing to consider that lenders consider is when you're looking at a bridge or a HELOC, we have to consider that monthly payment and you're qualifying for debt to income ratio. So you do need to have room to carry the current financing and the new financing. And so we include wherever you're drawing those funds from in your monthly payment. Okay. One of my favorite, I'm going to skip back up now to a 401k loan or a line of credit on an investment fund. This is one of the best options that I guide people to look at to get money for a down payment. And the reason being, we love it as a lender because I do not have to include a payment on that because it's your own money. So if you take a line of credit on a 401k or an investment account, I don't have to include it in your debt to income ratio most of the time. Now, there are some possible jumbo products or unique products out there that I could have to include it. Most of the time, it doesn't even go into your debt to income ratio because you're borrowing from your own asset. So every situation on this is different and everybody has different access to money. So that's another thing. When you start really soon, I say, let's look at all the avenues. If you are currently working and you have a 401k, first thing I say is call your 401k, not your advisor, but you know, who's controlling your 401k, find out what your options are. Can you take a 401k loan? Now, I don't mean a distribution from your 401k. I literally mean a loan from your 401k, and then you pay it back. Usually it's a draw from your paycheck. I know some people that can tap a line of credit to their investment account. So just a normal non-retirement investment account, like a joint investment account. Not everybody can. So that's one thing. If you do have that realm and that ability, and you work with a financial advisor, or whoever is handling that investment account, I would reach out to them and see what the options are. That's another good one. And both of these are another scenario where you're not going to have a payment on it until you draw the funds. So this is a great one. I personally have attached a line of credit to an investment account as a safety net for my husband and I, and we just have it sitting there. We don't pay anything on it. It didn't cost us anything to set it up. But I mean, there is interest involved, and it's usually variable and stuff like that, but it's a safety net for us to have that there. So that's another good thing, that it doesn't hurt you to look into any of these options for anything that you're trying to plan down the line in your life.
Yeah. And just knowing about that, and then just kind of having a plan, even if you change it later on,
Yeah.
will be helpful.
And a lot of people don't know what options are out there. You know what I mean? So you might as well, like, I see a lot of people where it's not a bad idea to attach a HELOC or a line of credit to something you have as just a safety
have it.
net.
Yeah.
Yes, because the things that you think about, like with the HELOC, is when somebody needs a HELOC, you still have to qualify, right? So when somebody needs a HELOC, let's say you lose your job and you need a HELOC, well, you have to think about, well, you lost your job, and so you don't have income coming in. So it's always good to maybe attach those safety nets on there before you get to a point where you're maybe in a panic and you need to qualify for something, whatever the reason be.
Yeah.
So Kim, with the 401k loan, does it work in the that you described the HELOC working, where it's sort of like a credit card and you only pay? Okay, so it's different.
Well, you know what? I can't definitively answer, because there might be employers out there that do things differently. But I personally have never seen a 401k loan. It's usually you fill out the paperwork, it's a lump sum draw. And a lot of the times, like, your employer wants to know the reason behind it. So usually when somebody is doing a 401k loan as part of a mortgage transaction, I have to provide, you know, they have to submit specific paperwork to their employer to release it. So they want to see the loan estimate, sometimes the purchase contract. They won't just give you a 401k loan for any reason most of the time.
Okay.
Usually it's a lump sum distribution, and then there's probably an agreement, and every employer can be different here, set up on how you pay that back.
Okay.
Okay. So usually it's a monthly deduction from your paycheck, just like health insurance or something like that.
Okay, great.
Okay. But again, the beauty of both of those is, and will you go back one? I don't think I'm quite through it.
Sorry. I'm sorry.
That's okay. The beauty of both of those is, from a lending standpoint for pre-planning, we have to include things like HELOCs and bridge loans in your qualifying for debt to income ratio. 401k loan, investment loan, we typically do not have to include, and we love that.
Okay.
One of the other big things to consider when you're just trying to get some money to put the down payment on the new home is you don't necessarily need a giant down payment. A lot of people that I work with, they might put the minimum down that they put down that they either need for that loan type, or they need, I'll answer your question in just a minute, Marlon. Just enough to put down for the minimum down payment requirement or what they need to qualify. And then they sell their home, and we do a giant recast on the loan. And what a recast is it's not just a principal reduction. It's actually a recast. You take a big chunk, you pay the principal down, they recast the payment based off of the new principal balance. So it adjusts your payment down. So you're temporary bridging that smaller down payment on that mortgage, selling your house, using that huge lump sum of net proceeds, recasting the loan, and you were where you wanted to be in the end, but you did not have to go in with a contingency. That is a really good way to do it. The beauty of a recast, unlike a refinance, is it's usually very inexpensive. Every servicer is different, so there's no full guarantee, and not every servicer does it, but I'm going to probably say 99% do. I honestly have not met a servicer yet that won't recast. And I've seen it as little as $50 and as much as $500. A lot less expensive than title fees, appraisals, and stuff like that on a refinance. So that's a really good option.
Is there a time
Um,
limit on that?
Mm,
Like, did you have to
so
recast
this is
within a
hard too,
certain
because
amount?
every servicer can be different.
Okay,
I've never seen a time period. Now, I've seen some where it's like, we need you to make your first 2 payments and then you can recast because they've got to get it in the system. But I've never seen anybody get pushback other than something like that. Like, we might need you to make a payment or 2 just because we need to get it in the system and stuff like that. Any other questions about that? That's a really good one because, sometimes people, maybe on your 401k loan, you can only draw 30 grand or 50 grand. It gets you enough to put that down payment down. But let's say you're going to net 200,000 from the sale of your home. Then you take that 200,000, maybe you pay back your 401k loan, and then you take the other 150 and you recast your mortgage.
perfect.
For an IRA, I honestly can't answer that question. I would, if you have somebody that's handling it, a financial advisor, or just whoever's holding the IRA directly, I would contact them. I personally have never seen anybody attach a line of credit to an IRA. I've only seen it on just a normal investment account. And I've never seen anybody take a loan from an IRA, just a 401k, but it doesn't mean it doesn't exist. It's just maybe something that I've never seen in my wheelhouse come across my desk. So I would definitely check with a financial advisor or the person holding your IRA.
I had seen previously where people were changing their IRAs to like self-directed IRAs, and then they were able to do that. But I'm not sure if that's only for investment properties or if that's also for primary residences. So yes, definitely talk to the financial institution that's holding the IRA. Absolutely.
Yeah. The other 2 things to think about. So when you're looking at, and this is a qualifying thing, and this isn't anything that you guys need to know, but just know why starting with a lender is better than anything, because there are options out there. Let's say you don't want to sell your current home. There are options out there that you can retain that home and keep it as a rental. And what's the beauty about that is most loan types, I can use some rental income on a lease to offset the purchase. And again, every loan type is different, so every situation is different. But there are things out there that lenders can do to help in qualifying with retaining 2 properties. So you might not, if you want to keep the property as a rental, then maybe we look at that avenue for you. Might be something to consider if you have financed in the last couple of years and you have a 2% interest rate. You know what I mean? Like, Susanna can probably help guide you guys on that, but you might be able to make some money off of a rental.
Yeah, absolutely. Especially with it, like you said, with the 2% interest rate, that's really hard to give up on top of it.
Yeah. And it's not, you could keep it. And if you still need down payment funds from the house, you can look at avenues of trying to attach HELOCs to the property and stuff like that. But that's where when you go to the bank and you're trying to apply for something, you just need to tell them what you're doing, because a lot of banks too, they don't want to attach a HELOC to an investment property. Not all of them will do it. So you just want to really just be upfront with what you're trying to do, or just pre-plan well ahead of time. So yes, we can look at keeping your property using lease income and stuff like that. Back to the recasting real quick before I forget, because I don't want to mislead anybody. Typically, you can only recast a conventional loan. So you usually cannot recast a government loan. So like VA or FHA. So that's just something important to note. If you wanted to try to do the same thing as recasting with one of those types of loans, you would have to do a full refinance. But not a bad thing, if that's what you're looking at, a VA loan, if that's an option. We're hoping rates will come back down. You might want to refinance in the future anyway, just depending. Of course, we never know. And that leads into strategies for lowering interest rates and monthly payments. So rates are definitely a little bit higher now than we've seen in the last several years. But there are things out there to don't be so afraid of what's going on in the market, because there are options out there. One of those, a very, very popular thing right now is what we call a 2-1 buy down. And this is really important for you to hear this too, in regards to selling your house, because this might come down the pipeline on an offer that you have coming in. I actually just took a phone call today from somebody with a listing, just trying to get information on how a 2-1 buy down works. So what it is it's funded. It usually has to be funded by a lender or a seller. Most of the time it makes the most sense for it to be funded by a seller, because what a lender is going to do is increase the interest rate to cover the buy down, which is what you're trying to avoid. So if it's funded by the seller pays, if it's a 2-1 buy down, your interest rate, the payment is based on an interest rate that's 2% less the first year and 1% less the second year. So the rate isn't actually less, but what the lender does is we calculate the difference in the payment between the two rates. Your baseline note rate, let's say, is 6%, the first year rate of 4%. Let's just say the difference in that monthly payment is $500 a month. We take $500 a month, we multiply it by 12 for the first year, that number goes into a pot. We do the same thing. The difference in the payment from 6% to 5% for the second year, whatever the difference is over that 12 months, it goes in a pot. So that's the amount that the seller has to cover in a concession to fund your 2-1 buy down. It has a pretty large impact on what it can do for your monthly payment. So if you're not loving the rates right now at 6% and you wish the rates were 4%, well, this is how it gets you that 4% rate for at least the first year, and then possibly 5% for the second year. Now, of course, the premise behind it is we hope that there's going to be a chance to refinance before you get to that third year. But I always tell people, and I go through the numbers very, very, diligently with them, you have to be comfortable with that third year payment in case there is not a chance to ever be able to refinance. But the other beauty of a 2-1 buy down, if there ever isn't a chance to refi, you're still at the rate you would have been anyway. So it's not costing you anything to get into that 2-1 buy down. And it helps sometimes ease people into a payment, because usually people are going to get pay raises, and you know what I mean? Things come along in life where they can ease into a higher payment over a couple of years, instead of just a flip of a switch going from a 4% rate to a 6% rate. So that there are options out there that are available to try to help you. If now's the time that you want to get into a home, there are options out there to ease into that payment or look at the lower rate. Of course, you can do things like buying down interest rates permanently and things like that. But that's where, if you get with a lender, we will help guide you and compare and figure out what is the best path for you. And the last beauty of a 2-1 buy down is the money. It's not like a permanent interest rate buy down. The money goes into that pot that I said, and we pull from it every single month to add to that monthly payment. And whatever, if let's say you refinance at the 16-month mark, whatever's left over in that 2-1 buy down account gets reduced from your principal balance. So the money doesn't go to waste. And that is what is really, really a positive thing about a 2-1 buy down. So there are options out there. There are all kinds of options out there. So talking to a lender can just help you guys digest that. And the biggest thing to think about is people like Susanna. Well, sorry, I'm speaking for you, Susanna, and myself. Like, we're here to help you with no obligation and no, please use people like her and I to get that knowledge and the resource there to look at these avenues. You're never committed to anything. That's not going to cost you anything, just to gather the information. That's exactly what we're here for.
Yes, I absolutely love that. And it's, yeah, and it's so true. And there's a lot to take in. So, you know, if you start early, you'll hear it multiple times and it'll sink in, you know, eventually. I mean, we do this every day. So, we're comfortable with the jargon, but you're being kind of thrown into this subject matter. So yeah, the earlier you start, the better. You get an ear for that, and you just
Yeah. And I'm throwing out all these options to you, and it can seem a little bit overwhelming, but that's where people like Susanna and myself come into play, because my job is to get your full picture and help guide you. Okay, this option's not going to work. This option will. Let's compare this and this. That's what we're here to help figure that out for you. So it's not such an overwhelming process.
very cool. Ready for the next step? All right. So, well, big question. How much time is needed? I would say at least 6 months to kind of get started and get the information. Would you agree, Kim?
Yep, I do. I seriously so strongly agree that there's never a point that's too soon. The biggest thing from a lending standpoint and looking at starting this process is a credit report. A credit report is good for 120 days. But to be totally honest with you, if it takes 6 months or 8 months or even 5 months, if I'm pulling a credit report 4 months apart from each other, it's not going to hurt. It's really going to be really little detriment to you. But let's say you start 6 months early and I pull the report and boom, there's a medical collection on there that you didn't even know that was on there, because that happens with people with impeccable credit sometimes. That gives us 6 months to get it fixed before I pull that next credit report.
Yeah, and that also doesn't mean that we can't, you know, that you can't do it quicker. Of course you can.
Oh.
We're just talking ideal timelines.
That's the other thing too, is I don't know how often this has happened with you, Susanna, but I'll take a call of somebody that's like, I'm looking like my lease is up 8 months down the road, but I just kind of want to start the process and look at numbers. And that's what I help them with. Like, here's what payments look like. Here's what numbers look like. And the next thing I know, a month later, they're like, we just found our dream house. We have to have it. And they were ready. They're ready to go. And if it sits for 8 months and you're not ready to go and we have to pull a new credit report 8 months down the line, that's the worst that can happen, where at least you're prepared.
Yeah, you know, I mean, you'd think, so we all talk about this timeline, right? But it's actually, for many people, for a lot of people, I see that real estate is kind of like quite a snap decision. It's like, I see the house, I got to have it, you know,
Yeah.
and then you get everything in motion versus the other way around. But, which, I mean, I do understand, but, so on my end, of course, and Marlon, I saw your question. We'll get to that. So when, you know, I'm here to help you prep your home. We'll walk through, I will give you suggestions. What you do and how much money you spend is certainly, you know, totally up to you. I will give you suggestions on, you know, what is currently trending, what sells really well. So for the longest time now, we've had gray. Gray is still pretty popular, but it's starting to become a little bit more soft. It's, you know, some people consider it a little stock right now, you know, a little sterile. And so if you know, you can mix some other colors in. I will tell you which colors you know, which walls you really have to repaint. And just overall how to prep your home. And I see it all the time that it becomes such a hard push to do everything within a short period of time. It's super stressful. So in order to keep all that down, that stress level down, those 6 months are really great. You can, in peace and quiet, go through your house, you know, get a pre-inspection, take care of all the maintenance items, and be prepared that way. And then if we see any fluctuations in the market, you're ready like this and you have everything in place. So,
Or you find a house that you really want and you need to get your house on the market, right?
yes, exactly.
Yeah.
Yes, exactly. And, you know, and just like with Kim, you know, I can give you different scenarios. If we sell, you know, your house for this much, you know, then your net proceeds are, you know, give you a little bit of a, just an estimate. If you sell for this, then it's this. So if you, so, and then you can pass that on to Kim, and Kim can work with that as well. So yeah, being prepared and then ready for either, you know, the market fluctuation, or you see the house of your dreams, which of course is ideal.
So Susanna, can you talk a little bit about, because you have pre-inspection right there, can you talk a little bit about what the advantage of having your home inspected before you even list it and how that plays in, especially with this dual transaction situation where you're buying and selling at the same time?
Yes. So what happens? So if you don't get a pre-inspection, you're a little bit at the mercy of the sellers, of the buyers, which is really tough, especially when you have another transaction depending on your house selling. So if you're surprised by, you know, a roof replacement or a sewer line replacement, which can be very, very expensive, then, you know, you're kind of in the corner and you have to just basically just do it, just fix it, and just right then and there. Not only is that stressful, it's also expensive usually, because, you know, you don't have time to do your research. You usually don't have enough time to talk to contractors. And that's when you have a pre-inspection, you can review all these items and you can get everything done on your timeline, and especially for you, you know, for usually a better price, because you do have that luxury of time. And on top of that, if you have your house listed and you get an offer, then you can say, by the way, buyers, here is my pre-inspection. Before we even go any further, you know, we would really like to know if there's anything that would concern you. Now, you can still do your inspection, but, you know, we'd really like to know if there are any red flags before we even move further. And many times I see actually buyers using the inspection that you have provided and say, oh, well, then then they don't have another inspection. So it is so much smoother, especially considering that you have another contract, you know, riding on your sale. Last thing you want is having to start at zero because your contract falls out. And actually, I just spoke with a title person this morning who told me that she sees as high as 45% of her closings falling out of contract for one reason or another, which is really, really high.
Can I add in just a little bit on top of that of not being surprised by repairs? Because one other thing to consider about this is if you, let's say you have a major repair that you weren't aware of, you know, something huge, a roof or sewer line, just like she said, and you find out about it in the middle of the transaction, what might end up having to happen if you're trying to hold both transactions together is you still got to get closed on the other one. So what happens is you end up closing sometimes with a repair escrow. And when that happens, most of the time, that lender of the person buying the house is going to require that escrow being hold. So they hold, you get an invoice for the repair. They will actually hold 125 to 150% of the cost of the repair. And it's not that they're going to keep that money. They'll give it back to you once the repair has been fixed. But the thing to consider is if you're banking on that money for your down payment, you might not have as much as you think for that down payment on the next house.
Ooh,
If they're holding 150% of whatever the repair was in your escrow holdback.
yeah.
Does that make sense?
Didn't even think of that.
I literally I've encountered that issue before. So that's just one thing to think about of if you pre-inspect, you know what's coming down the pipeline, and little nuances like that are, and that happens very few and far between, but why not be prepared, right? Why not be prepared?
Absolutely, yeah. You know, and actually, just real quick, some sellers opt to not go for pre-inspection because the hope is that the buyers won't discover something, you know, and I think that's the wrong point of view to have. I think really being prepared and knowing what is going on, because the inspectors, they're pretty much all the same. Most of them find everything because that's their job. That's the only thing they have to do, find things wrong with your house. And so, you know, if there is something wrong, they'll find it. You might as well know ahead of time, you know. And Marlon, just you know, wanting to answer your question. So I'm not sure if it's if you're asking when you're bidding on a house and there are multiple offers, in which case, you know, we would discuss, you know, any kind of, you know, strategies that you can use to win that multiple offer. I would tell you, you know, throw in your hat in the ring as much as you're comfortable, so that when you don't get it, when you don't win that multiple offer, that you can walk away, you can throw up your hands and say, you know what, this is all that I was willing to do. If somebody is willing to pay $150,000 over list price, I can't help them. So that's kind of the attitude you have to have, and we've always done well with that. I mean, people are, you know, buyers are still sad when they're losing it, but there's a certain point where you just have to say, you know what, just doesn't work. If you have multiple offers on your house, we would sit down, compare both or 3, 4 offers next to each other and see which are the safest, most likely to close and get you the most money at the same time. And then you decide. I mean, last year we actually ended up having to make spreadsheets, you know, where when we had 12, 15 offers, we would do spreadsheets and then just compare and talk about it. So, yeah, I hope that answered your question with multiple offers. What time of year is it best to get a pre-inspection? You know, I mean, it depends on when you want to list your house and how much time you would prefer to have before you are putting it on the market. You know, I think if you're 4 weeks out, that would be the minimum. You know, if you do it, you know, between 4 weeks and 3 months before you want to list, I think that's best. If you go any further out, you know, you might have a hailstorm or windstorm coming up, and then the roof might not, you know, might get damaged, or you have other damage coming up. So I think between 1 and 3 months prior to your listing the home, I think is sufficient, gives you enough time to repair anything that's necessary. And by the way, you don't have to have all things fixed by professionals. You can do it yourself. You know, if you're handy, by all means, you know, fix it. So, all right.
So, would you guys say, because we have list current house for sale first and then shop for new home, but those are sort of inverted sometimes, just depending on people's specific situations, what type of maybe loan product they're using and that type of thing, right? So that can be interchanged, but would you say it's ideal to list the house for sale first and then start shopping, if at all possible?
So since the market has changed, I think it would be better to list first, and then, you know, should unexpectedly should you go under contract within like the first, you know, 10 days or something like that, you know, then we can always, you know, ask for a lease back or something like that. I mean, there are things that you can negotiate and help this happen. I mean, if push comes to shove, you know, you would just have to move twice. I would always recommend to have that as a plan B and not, you know, see yourself being pushed in the corner and buying a house that you don't really love just because, you know, you have to find one. You know, consider, oh, well, you know what, if it doesn't work out, we'll just have to move in an Airbnb for a couple of weeks or so. I know it's stressful, or it's just a lot of work, but I think that's the best scenario, just to have that and as a plan B if you don't find a new home right away. So list your current house for sale. I would do that first. That way, when you find a home that you'd like to buy, you can at least show that your property is listed, at least listed, even if it's not under contract.
But if somebody were to find a house they wanted to buy and wanted to go ahead and move forward with that, it's not a deal breaker. That's also possible.
Depends on the seller of the house that you're looking to buy. When I just had that a few months ago, the seller refused to take our offer because the house wasn't listed. So 3 times. We offered 3 times, and then the 4th time they took it. So, you know, we were hard-headed, but we got it done, and we got actually a lower price on top of it. Yes, whatever you decide to do and however life works out for you, we'll just make it work. That's what we're here for. So, all right. So just to recap, give yourself plenty of time to do all the research, and then that gives you all the knowledge that you need to pre-plan as much as possible. So we have systems in place to help you with that. We have selling guides, we have all kinds of education on our website as well. But please, by all means, you know, like Kim said, we're here for you. You call us, you have a person to talk to, not, you know, you're not on hold forever. We get back with you personally. If it's on the weekends, it's on the weekends. It's okay, because, you know, life sometimes just can't wait. And that's why we're here and why we're making ourselves available when it does happen. So yes, we can connect you to industry partners if you have repairs questions, you know, stagers. We certainly have all those in place, those recommendations, and we're happy to provide those to you to help you get ready. Talk to Kim when you have any questions about finances, and then be prepared to move forward with your plan, and yeah, have a plan B in place. So backup plan. Things sometimes don't work out the way you have them planned, so you just need to make sure that you can, you know, step sideways. So, oh yeah, and don't close on a Friday afternoon or Monday morning. Kim, tell me,
Please,
is it true?
Please. Well, if it's a single transaction, it's not as scary. But when you're trying to do back-to-back, let's say you're doing a buy and a sell, I just ask people to please avoid Friday, because if something does go a little awry, like let's say you close on the purchase at noon, or on your sale at noon, and you're trying to close on your purchase at 3, but the title company on your sale didn't get the funds wire, you know, like you have wire issues or anything like that. It can just be a little bit hectic on a Friday, because if it doesn't happen on Friday, you have to wait the whole weekend to Monday. So, and sometimes people will be homeless, or you know what I mean? So it's just always better when you're doing multiple transactions like that to try to avoid a Friday afternoon, even early Friday, Thursday. Give yourself a little bit of leeway there. And if this is going down on a Friday afternoon, and this is just my lending perspective is, if I'm not your lender, don't be afraid to babysit your lender. You know what I mean? When I have a Friday afternoon closing, I don't wait until 4 o'clock to get there to make sure the wires arrived. You know, I'm contacting the title rep to make sure the wire is really there. Because once you're past that 2 o'clock wire deadline, you know, there's not much you can
You're
do.
dead in
So
the
just
water.
always, just try to avoid it. But if you can't, babysit it.
And expect for the seller of the home that you're buying not to allow you to put any item, any suitcase or anything, not even into the garage. Can it happen? Sure, we will ask. But if you're on the selling side and you have a buyer ask if they can do that, I would have to advise you not to allow it.
Because
Yeah,
it's too much liability, right?
it's
some-
too much liability. And, you know, and I will tell you that when I have spoken with other real estate professionals, they were like, oh, you know, it's not that bad. But I think I'm a little scarred from, you know, the 2011, 2012, with the recovery coming out of the recession, where it would happen that, you know, people actually moved in on that Friday and the loan fell through. And the sellers actually had to officially evict those people that are now living in that house. And so, yeah, so I have very strong opinions about that. In the end, you know, it's of course your own decision if you're on the selling side, but yeah, that's my recommendation. So another question, is it a good return of investment on a pergola or a patio overhang, knowing you will be moving if you find a home? No, I don't think. I mean, it all depends on the price, you know, how much it is. But my opinion is, if you're just installing a pergola for the purpose to sell it, I don't think it's worthwhile. I really don't. I mean, might have something to do also how your house is facing and the setup of your home. But I don't think that's a big issue. I have never had any buyer say, I'm not buying this house because there's no pergola on the back. And now I've heard buyers say, oh, we'll just go to Costco and we buy, you know, a pergola, but otherwise, no, I don't think so. So, yeah, like I said, if you have one, great, but if you don't do it for the sale of your home. So that's my personal opinion. So, all right, what's next? We invite you to call us to get a personalized strategy to move forward with your plans in the future with selling and buying a home. But even if you're not in the process right now or for the next year or two, I think it's really important to know, and especially since Kim mentioned, you know, having a HELOC in place or a line of credit just as a safety net. Those are some really great strategies to put into place just for your own safety, and they help you should you decide, oh my gosh, I want to just do this, and this might be in 12 months and 14 months. You just didn't expect it because, you know, life is that way. We have a buyer and a seller's guide for you prepared. Feel free to download it if you have any questions. We would certainly love to speak with you, and Kim is available as well.
And the links to the buyer guide and seller guide are in your chat. And then we'll also send those in a follow-up email after the webinar. And I think you guys have contact information on the next slide as well.
Oh, yes, I am so sorry. So first of all, are there any other questions? You should be able to talk if you wanted to. I just enabled that. So you don't necessarily just have to, you know, write it in the chat. If it's personal, please give us a call. We don't, you know, if it's general information, we're happy to respond here. So otherwise, so our direct phone numbers right here. You know, you will reach Kim and me directly through our direct line. So there's not a phone line. This is our, call it our ball and chain, right? The cell phone. And yeah, you get straight to us, directly to us. And should you not reach us, we will call you back as soon as we can. All right. So I hope you found this helpful. And yeah, again, if you have any questions, give us a call, download the resources that we put in the chat for you. And we're, like I said, we're going to mail this out. And we're looking forward to speaking with you, and thank you for visiting and watching this. And we hope to see you soon and talk to you soon. Bye. All right.